Good afternoon, everyone. We are ready to begin the year-end tax planning and PPP considerations webinar. We're just going to talk about some things to consider as we close the books for the year for 2020. Today, your presenters will be myself, Brittany Carman. I am a senior manager in the Chattanooga office for HHM, and I'm joined by Brittany Foley, and I will let her give a little introduction and begin our day.
Good morning, everybody. Thanks for joining us today. I'm Brittany Foley. I sit in the Memphis office for HHM. I'm a tax senior manager here, and I serve clients all over the Southeast. Today, we're going to talk about two hot topics right now. One is, of course, 2020 year-end tax planning and some considerations to think as you're in the next 6 weeks before closing those books. And then we're going to talk about some PPP loan updates and the tax considerations along with those. We're going to cover some frequently asked questions in both areas. And at the end, we hope to have a live Q&A. Please feel free to send some questions through chat as we go through the presentation. And we'll try to address some of those questions at the end. And if we are not able to get all the questions, we will be sure to answer your questions in an email. So let's get started. So we're sitting here in 2020. It's been one of the craziest and weirdest years for us all, I know. For those of us in the tax world, it's been the year of the never-ending tax season. And now here we are again talking about taxes. So the CARES Act brought in a lot of new tax considerations that we're going to walk through and some things to really think about this year when you're meeting with your tax advisors over the next couple of weeks. This year, I'm going to say is going to be kind of an atypical tax planning year. And why I say that is because there's so many things that are different than normal when we're sitting at the table in November talking about closing our books. Normally, all we're talking about is how can we defer income and how can we accelerate deductions. That may still be the answer for your specific situation, but it may not be this year. There's a couple things that may make that different. One is if you have been negatively impacted this year due to the coronavirus and the pandemic and your income is significantly down from prior years and what you expect it to rebound to in 2020, it may be a time that you're thinking about increasing income into 2020 because you're going to be in a lower tax bracket than you typically are, and deferring those expenses to 2021 when they would be more valuable because you'll be in a higher tax bracket. Also, you may want to defer that income and accelerate those deductions because of the net operating loss carryback rules that changed. This is something that has really been a hot topic in our office, you know, as we've closed out 2019 tax returns and saw where income fell and this change. So what happened is when the Trump tax laws, the Tax Cuts and Jobs Act was passed in 2018, it eliminated the NOL carryback altogether. And it said you can only now carry forward your net operating losses, and hey, you can only carry forward 80% of them. Can't even carry forward the whole amount. The CARES Act that was passed in 2020 reinstated the net operating loss carryback to allow net operating losses from 2018, 2019, and 2020 to be carried back. And they extended it past the normal 2-year carryback to the carryback. You can now carry it back 5 years. If we all remember back in 2008, this also happened during the recession, and that year they allowed carrybacks for 5 years. So what this is a great opportunity for clients who may have had a loss in 18 or 19 to go back and file for refund claims for those years. Taking 2018, you could take it all the way back to 2013. And if you think about it, in 2013, we were under the old tax rates. So in 2013, an individual's highest tax bracket was 39.6. A corporation's was 35%. And in 18, those rates are 37% and 21%. So you can really take a large advantage of that tax rate arbitrage, carrying back to those higher tax rate years. Same thing for 2019, you could carry it all the way back to 2014. So we're seeing a lot of clients taking advantage of this. And for 2019, you still have the opportunity to file a tentative claim refund form, which is form 1139, that would get you your refund immediately. Or you can also just go back and amend 2018 and 2019. If you want to do the quick claim, you've got to have that filed for 19 by December 31st. The deadline to do that same form for 2018 has already passed, so you would need to file an amended 2018 return. In addition to the NOL carryback, the CARES Act also made a change to qualified improvement property bonus depreciation. A lot of people, when the Trump tax law was passed in 2018, believed that a quote unquote mistake had been made and not including leasehold improvement property as 15-year property. It was now included as a 39-year property in that Tax Cuts and Jobs Act. The CARES Act has retroactively said that qualified improvement property now is 15-year property. And since 15-year property is eligible for 100% bonus depreciation, you can go back and claim those leasehold improvement property additions at 100% bonus in both 2018 and 2019, and it will be allowed for 2020 as well. So there's a couple options on how you can do that. One is you could go, if you want to get the cash now, get your refund immediately, you could amend 2018 and 2019 tax returns, including that additional bonus depreciation. Or you can choose to file a Form 3115, which is an accounting method change, and take the deduction in 2020 as a 481A adjustment on your 2020 tax return. So this is something that I'd highly recommend getting with your tax advisor about, seeing what makes sense for you and your personal situation, your business's situation, and make sure you take advantage of that additional bonus depreciation. Another thing that was changed in the CARES Act was the opportunity to delay your payroll tax deduction. So what it says is you could defer your employer 6.2% payroll tax that you owe, and you can defer it for the remainder of 2020 and pay half of it by December 31st of 2021, pay the other half of it by December 31st of 2022. A lot of clients that are in having liquidity issues are taking advantage of this and going ahead and deferring that amount so that they can continue to operate their business as well as they can during these times. But then but you might want to consider, if you are going to do this, if you have an NOL for 2019 or for 2020, and you plan to carry that back, you may want to go ahead and pay that so that you're going to take advantage of that additional deduction in 2020, where you could take it back to the 2015 and really take advantage of that tax rate arbitrage that we talked about a little bit earlier. So like I said, there's a lot of considerations to think about. It's not cut and dry. Everybody's got kind of their own playbook here, and we've really got to dig deep into the weeds and see where each client needs to make some changes and maybe defer income, recognize income now. One thing I didn't say earlier that I meant to say was all these items that we're talking about are as the tax legislation stands today. There's a lot of talk about what happens in January if the Senate were to go Democrat. And we may have to have another webinar at that point to talk about some of these items as well. But I think that for now, we're just going to talk about what is today. Another opportunity that people have right now that we're working with clients on are opportunity zone funds. This has been a hot topic over the last year, really year and a half. The opportunity zone funds are great, have great tax advantages to defer capital gains. What these are partnerships that invest in low income and undercapitalized communities. So as an individual, you could decide to invest in this partnership and you would use money from capital gains sales to invest, and then you can defer those capital gains until December 31st of 2026. What also happens is after 5 years, you get a basis step up of your previously earned capital gains invested. So you would get to step up your basis after 5 years, 10%. After 7 years, you get to step up your basis 15%. And then after 10 years, it's a permanent exclusion of taxable income on any new gains. So if you invest $1 million and now you've got $1.5 million, that $500,000 would be tax-free capital gains. A lot of clients, we have clients who are actually opportunity zone fund managers. So we're able to get clients in touch with these managers to invest in, and then the manager runs the fund. So it's kind of, you give your money and you don't really have to worry about it. They handle it all, which is really nice. Another big thing that a lot of people are talking about right now is gifting. With the Tax Cuts and Jobs Act passed in 2018, one of the biggest things that changed was the 5.49 million gift tax exemption at that time was increased to now in 2020, it's 11.58 million a person. So a couple can gift $23.2 million basically and pay and have it all exempt from estate tax and gift tax. This is a huge opportunity for planning right now. Really need to pay attention to your gifting opportunity right now to maximize that exclusion. It could decrease if there is a tax legislation change. Biden has stated that he plans to decrease that if he were to be able to pass new tax legislation. So a lot of clients are working right now to really look at that gifting. And no matter what, even in the Tax Cuts and Jobs Act, this 11.5 million sunsets back to the 5.49 in December of 2025, December 31st of 2025, if nothing else is done. So we know no matter what, come December 31st, 2025, that 11.58 is at this time going back to 5.49. So it's really time to take a look at your estate, see what you've got going on, what's the ownership of your companies. Do you want to gift some of that? Is it time to get a valuation on your company to see, what that gifting would look like? It's an opportunity to really maximize that exclusion right now. These past topics are really the main year-end tax planning things we're talking to clients about. As I said, everybody's situation is different. So we really want to get with our clients. We are encouraging everyone to get with their advisors, bring up these topics and really, deep dive into them. I'm going to let Brittany move on to PPP updates and then I'll talk about PPP tax considerations, but please put any questions you may have and we'll try to address them.
Thanks, Brittany. All right, I'm going to cover give a little bit of background on the PPP loan, as well as some updates and the most recent developments related to those funds. Just a reminder, the Paycheck Protection Program funding ended August 8th. And initially, when borrowers received funds, the term of the loan was for 2 years. However, that was changed later on. And so at this point, if the loan was received before June 5th, then it typically has a 2-year maturity date. But if the loan was received after June 5th, then it has a 5-year maturity date. But for those 2-year loans, the borrower may agree with the lender to extend the term of the loan to 5 years if they have a balance due after requesting forgiveness and applying for forgiveness. And so that's something that if you fall under that 2-year loan category, then it might be worth consulting with the lender if there's a balance that's going to be due after requesting forgiveness. And the promissory note for the PPP loan will state the term of the loan if there's any borrowers who are uncertain of their terms. This should also be taken into consideration for businesses at the end of the year who may have debt covenants that they need to comply with for the bank, and looking at needing a 5-year loan to reduce that current portion of note due in the next year. Also, all of the loans will accrue interest at 1% if the loan is not forgiven. And initially, the repayment of the loans were deferred for 6 months for any PPP funds. However, the Paycheck Protection Flexibility Act extended this deferral period for loan payments to either the date that the SBA remits the borrower's loan forgiveness amount to the lender, or if the lender does not apply for forgiveness, then that repayment would be deferred until 10 months after the end of the borrower's loan forgiveness covered period. And this extension for repayment automatically applies to all loans, and the SBA is not requiring any formal modification to the promissory note related to the deferment of the repayment. And then just to touch on the expenses that are qualified for forgiveness: payroll expenses, any wages, salaries, or commissions, but that is capped at $100,000 annually. Also, group healthcare benefits, sick, parental, or vacation and medical leave, and retirement benefits, a 401k match contribution made by a business. Certain amounts related to that can be included on the loan forgiveness request. And then the expenses that are not allowed for payroll costs would exclude any compensation in excess of $100,000 annualized to any one employee. And then also compensation to employees outside of the US and qualified sick leave that was used for credit under the Families First Coronavirus Response Act. So if there's any questions related to those payroll expenses, again, reach out to your service provider, your accountant, anyone here at HHM, and we can help decipher those payroll costs. And then the non-payroll allowed expenses relate to mortgage interest, rent, and utilities. And one development that did come later after the PPP funds were established is that rent expense that is paid to a related party is now limited to the mortgage interest expense that's paid on the mortgage during the covered period by the lessor. So that's something, if you're making rent payments to a related party, that's definitely something to consult on as to whether or not those expenses qualify for forgiveness. A few more areas of forgiveness. One thing I want to touch on is the payroll period, the covered period. The 8 or 24 week covered period is going to relate to costs that are paid or incurred during the 8 or 24 week covered period. That initial covered period is going to begin the day of that the funds were dispersed. However, there is also an alternative payroll covered period that relates strictly to the payroll costs. And this is an election that may be made for borrowers that have biweekly or more frequent payrolls. And they can elect to calculate the eligible payroll costs using the the pay period that begins on the first day of their first pay period following the PPP loan disbursement. However, this alternative payroll covered period is not allowed for any non-payroll expenses. The non-payroll expenses would be paid during the covered period. Keep in mind that a borrower can choose to apply for forgiveness before the end of the covered period, but the catch with doing this is that it may lower the maximum eligible compensation if there were any reductions in salary and things like that. Also, I wanted to touch on the 60-40 rule. When the PPP program was initially laid out, the rule was that 75% of the expenses needed to be used for payroll, and then 25% could relate to the other expenses. But the Flexibility Act also reduced this percentage and allows for payroll expenses to relate to 60% of the expenses used by the loan proceeds, and no more than 40% of the loan proceeds may go to eligible non-payroll expenses. And then also there is a December 31st rule, and this relates to the FTE safe harbor reduction rule. And if the borrower reduced its FTE levels from the period to February 15th, 2020 through April 26th of 2020, and then the borrower restores their FTE levels by no later than December 31st, then they can use the levels, then they will not have a reduction in their FTE count if the FTEs are restored by December 31st. Another question that we have received frequently is whether or not bonuses are allowed. And it doesn't appear that bonuses are a problem, since the pay is looked at as an average over the covered period, or the alternative payroll covered period. So in this example that I've got here, this is for an 8-week period. But if you look, there was an employee who had a base pay of $1,500 for 8 weeks, which was a total compensation of $12,000, and they received a catch-up bonus of $1,500 during that period. All of that $13,500 would qualify for forgiveness during that period. However, in example 2, you can see that there was an employee who received a weekly base pay of $2,000, and they only worked 7 weeks because they had possibly been let go and then were rehired after the first payroll period. So in order to catch up on the payroll expenses, they received a $2,500 bonus. However, in example 2, the payroll that would be qualified for forgiveness would be $15,385, because payroll and bonuses paid cannot exceed $15,385 for an 8-week period, as that would equate to $100,000 annualized. Also, take note that for a 24-week period, a non-owner employee would be allowed payroll expenses of $46,154, as that is annualized income up to $100,000 for a 24-week period. But any owners, the limit for their compensation would be $20,833, which is 2.5 months, which is what was used for the original funding of the PPP to calculate those funds. Now I want to talk a little bit about the different forms to request forgiveness. The standard form that was released by the SBA to request forgiveness is the Form 3508. And this form can be used by any business that received PPP funding when requesting forgiveness. This form does require the most calculations and the most documentation along with it. And then the other form that was issued at the same time was the PPP Easy form. And as it states, this form is easier to complete to request forgiveness. But there are limitations in who is allowed to use this form to request forgiveness. So the first qualification to be able to use this form is that it is for a self-employed individual or an independent contractor or a sole proprietor with no employees at the time of the application and when they requested the funding. The second qualification is for borrowers that did not reduce their salary and wages for any employee by more than 25% during their covered period, as compared to the period from January 1st to March 31st of 2020, and also that they did not reduce the number of hours, the number of employees or hours of employees between January 1st of 2020 and the end of the covered period as well. But this can ignore reductions related to employees who refused offers to be rehired or whose positions could not be filled with similarly qualified workers. And a big takeaway from that is if you had any reductions in headcount, but tried to hire or rehire employees to fill those positions, then maintaining that documentation to support the attempt to rehire is going to be very important to maintain when requesting forgiveness. And the third qualification for using the easy form is that the borrower did not have a salary and hourly wage reduction and that they were unable to operate during the covered period at the same level of business activity as before February 15th of 2020. And this would be due to compliance with requirements that were established by the CDC or the Secretary of Health and Human Services or any other official guidance issued that reduce the ability to operate at the same level of activity. And then just recently, on October 8th, the SBA released a third version of the PPP forgiveness application called the 3508S. And this form was created to simplify the forgiveness process and is only available for borrowers who received PPP funds of $50,000 or less. So the benefit to using the simplified version is that it requires fewer calculations and less documentation for the borrowers. Borrowers that use the 3508S are exempt from reductions in loan forgiveness amounts based on reductions in full-time equivalents, the FTEs and employees, or in salaries or wages. It also does not require borrowers to show the calculations used to determine their loan forgiveness amount. While these calculations are necessary and included on the initial form 3508 standard form. However, the SBA may request information and documents to review the calculations as part of their review process. So even if it's not required to provide all of this documentation to the bank with the initial application, that doesn't mean that the SBA or the bank can't come back and ask for additional information. So as you're preparing these forgiveness applications, it's important to get all the backup and have all the supporting documentation available in case questions arise later on. One of the latest developments is the necessity certification that has not officially been released, but has come up by the SBA that they are requesting additional information from borrowers who borrowed $2 million or more of PPP funds. So there's the form 3509, the loan necessity questionnaire for for-profit borrowers, and then an additional form 3510 related to loan necessity questionnaire for nonprofit borrowers. And one thing I'd like to note here is that the AICPA is following up with the Treasury and the SBA related to these forms and trying to understand them better. as they don't believe that the information that was requested is in line with the initial intent of the PPP Act. And this goes back to the initial guidance by the SBA regarding the required certification for applicants when they requested the PPP funds, that the current economic uncertainty made this loan request necessary to support the ongoing operations of the applicant. The initial intent was that this would help businesses continue to thrive and keep people employed. And so this is a new development that will continue following and give updates as it may be subject to change. But I will go through a little bit of the information that is requested from the necessity certifications. The first is a business activity assessment. And this section requires information relating to the impact of COVID-19 on the borrower's business, including required or voluntary business disclosures, revenue information, as well as detailed information on any changes to the operations of the business that were required to be made in response to government shutdowns. It also requests information on any capital improvements that were made between March 13th of 2020 and the end of the borrower's covered period. There is also a catch-all question that does allow the borrower to submit any additional information or comments that might bear information on any of the questions related to that activity. So that's a really important piece because it might allow borrowers their first opportunity to frame the issues that and challenges that may have occurred during that time period. And then there's also a liquidity assessment that requests information related to the cash position of the borrower at the end of the quarter, immediately before they requested the PPP funds. And then also whether the borrower has paid any dividends or made any other capital distributions other than pass-through estimated tax payments. They also request whether the borrower has paid any debt, made any prepayments there, and also looking at owner's compensation for any owners that their compensation exceeded $250,000 on an annual basis, and the number of employees and total compensation paid to those employees during the covered period. So there's a lot of other information, but those are the highlights that I'm going to touch on there. But one of the other things is that they also will request whether the borrower has received any other funds from any other CARES Act programs other than the PPP, excluding any tax benefits. In regards to financial reporting issues related to the PPP funds, there are two different ways that businesses can account for the PPP funding. The first option is to account for it as debt initially, and then record the debt as extinguishment of debt upon the legal release if the loan is forgiven. And then the second option is to account for the PPP funds as a grant. Typically, that would be government grant income, and recognize that income during the time that the related expenditures are incurred. And for a lot of nonprofits, if all of the expenses had not been incurred for a June 30th or a September 30th fiscal year end, then there may be a portion of the funds that are deferred, that are recorded as deferred income, to have the funds recognized as income match up with the expenditures. And again, to recognize the funds as grant income, it would need to be probable that the eligibility criteria and the forgiveness criteria are expected to be met. And typically that would be that there's at least a 75% basis that the criteria would be met. Otherwise, it should be recorded as debt. And this is also a place where the necessity certification should be taken into consideration. If a business has a loan in excess of $2 million, and we know that the SBA has said that they're going to audit any loans that were in excess of $2 million, and they've had to fill out this necessity questionnaire. Is it expected that those funds are going to be forgiven, or do those funds need to be recorded as a loan? There is, again, significant judgment used in recording these funds, but it'll be important to have documentation to support whatever treatment and which position is taken.
All right, Brittany Foley back. We are going to talk a little bit about some of the PPP tax implications and how that's going to look on the tax returns. Again, this is something that has had a lot of hype, I would say, by lobbyists and other people, as the intent for the PPP loan was to help businesses. Because as it states right now, there's no deduction for any expenses incurred that result in forgiveness of the loan. So if you got $1 million, you get $1 million forgiven because you used it all for payroll. You are not going to get to deduct that $1 million of payroll expense on your tax return. In addition, that income that you received will also, it will be a book tax difference. So it'll kind of be a net wash. You'll have income and then you'll have expenses that aren't allowed and it'll go away. That'll offset that income. The problem is for companies that maybe haven't had as big of an effect of their income maybe isn't down, and now they're going to not get a large W-2 expense on their tax return that they're used to having. So again, this is something that is going to be different in every situation, and it needs to be looked at hard when doing these fourth quarter kind of looks at our financial statements to see how we think that's going to affect your tax return. Another thing that's going to make it tricky is the timing of the forgiveness. So if your expenses were incurred in 2020, but you haven't gotten your forgiven letter in 2020, you don't get that till 2021. At the time of forgiveness is the time that the deduction becomes no longer deductible. So that's going to be an issue as well for all planning, because how do we defer? Do we defer those expenses? Do we make everything? Do we recognize the expense now, but then in 2021 have to do some sort of tax, book tax difference in 2021 to account for those expenses when they're forgiven? It's all something that you're going to have to talk to your tax advisor about how you're going to properly record those. Another issue with those expenses not being deductible is the fact that those expenses, your interest expense and your W-2 wage expense, both come into play when you're calculating your 163J interest limitation and your qualified business income for Section 199A. The interest obviously comes into effect for your Section 163J calc, and the W-2 wage expense for your Section 199A calculation. As it sits right now, you would have to reduce those expenses by the amounts that are not deductible. So if you paid $1 million in wages and 500,000 of it's forgiven, then 500,000 of it will not be allowed to be used for your Section 199A W-2 wage limit. Again, tricky issue, needs to be really looked at when calculating these 2020 estimates. You will have GAAP versus tax differences. For GAAP purposes, the income and those expenses would be on the books, and then you're going to have book tax differences on your tax return. One key thing to think about if you're self-employed or if you are a member of an LLC, your payroll in sense is either distributions or is distributions from your company. Those distributions have never been deducted on your in your tax filings. Therefore, you're not going to have an impact of, if your loan is forgiveness, you're not going to miss out. If your loan is forgiven, excuse me, your expenses for paying yourself were never deducted, so you're not going to have that negative effect of losing that expense on your tax return. Again, this is a really tricky and very complicated situation with all the timing issues and how it affects 163J and 199A and how self-employed individuals are treated differently. So I would really encourage you to get with your tax advisor, talk about your personal situation and how your PPP loan forgiveness is going to affect your tax return. I think now we're going to move into some frequently asked questions. Please also feel free to type any questions that may have come up regarding tax planning or PPP loans in the chat, in the Zoom chat, and we'll try to address those after this.
One question that we have received related to PPP funds is, what does the PPP borrower need to do if they are considering a change in ownership? Initial response, make sure to consult with their lender, accountant, and attorney. Prior to any change of ownership transaction, the borrower should notify the lender in writing regards to what the transaction entails and a copy of any proposed agreements that would affect the transaction. And then also there are different procedures depending on the circumstances of the change in ownership. For instance, in a structured asset sale, the borrower could be permitted to sell 50% or more of their assets without prior approval, only if the borrower completes a forgiveness application and submits it with the supporting documentation to their lender, and also deposits funds in an interest-bearing escrow account that's equal to the outstanding balance of the loan. And in that situation, after the forgiveness process is complete, then the funds in the escrow account would first be dispersed to pay any remaining balance on the PPP loan. Again, in that situation, and whenever considering a change in ownership, definitely consulting with the lender and also your accountant or attorney will help that process go smoothly, because there can be some restrictions or some challenges there. And the SBA has released a procedural notice related to the loans and changes in ownership. Another question that we've frequently received is whether or not PPP loans can be forgiven, have to be forgiven in whole, or if they can be forgiven in part. And the actual amount that is forgiven is going to depend on the total amount of payroll costs and other eligible costs that were paid during that covered period. So there could be reductions due to reduction in headcount or FTEs, or reductions in salaries and wages. So those are all things to take into consideration, as well as if that 60% metric wasn't hit as far as expenses related to payroll versus non-payroll costs. So those are all things to consider. And so there can be circumstances where only a portion of the loan will be forgiven, and there may be a piece that's still left in the balance and a loan that would need to be repaid. So it's not an all or nothing situation.
The question every year, obviously, is what do the tax brackets look like for the current year? Below are the 2020 tax brackets. As you'll see, for individuals, you don't hit the 37% tax rate until $518,000, and for married filing jointly, $622,000. So again, while you're doing your planning, you can use this tax bracket chart to help you see where you're going to fall out. And you'll see that these brackets are still in the Trump tax rates. They have the larger gaps in the brackets, which is great, larger range. And so we hope to see that continue.
Initially, upon the request for loan funding, there were affiliation rules. There is a guidance released by the PPP One thing to keep in mind is that they are going to be based on either ownership or affiliation rising under stock options, even management, or just identity of interest. But there is an exemption for certain religious organizations and a waiver for certain businesses and franchises. For any business with not more than 500 employees that fall under certain codes, there may be some exemptions there from the affiliation rules. But that's something definitely to consult with your accountant and your lender in regards to those affiliation rules. And the biggest question of all, we've got a lot of clients right now who are anxious to get their application for forgiveness turned into the bank so they can have everything taken care of and get this finalized by the end of the year. What we're hearing from banks is that that may not be happening because there is a process to have forgiveness granted. But in regards to how long does it take, the borrower has up to 10 months from the end of the covered period to apply for forgiveness. And once the application is submitted, the bank has 60 days to review and ask any questions and gather the documentation, which should be supplied with the request for forgiveness and with the application. But we have seen where the bank has come back and asked questions or asked for additional support, and they have 60 days to review. And then once the bank submits to the SBA actually has 90 days to approve. And again, there may be questions, and this is a new process. As we've mentioned, there are changes still happening monthly, and there may be more changes to come with the 3510 and the 3509 necessity forms. So, it's going to be a process, but I think it is good to get all the information together and, submit it and have that back in the bank's hands. And, but it will be a process, and it may not happen before the end of the year. One of the other things that I wanted to touch on again is just the documentation regarding any employees leaving and not coming back. That's going to be one of those things that the SBA may come back and ask questions if there were any reductions in headcount as far as why that's not taken into consideration. And then also to simplify things, if a borrower is able to use payroll costs and did not have to use mortgage or other expenses to support and request for full forgiveness, that may make it easier and simplify the process to request forgiveness if you rely only on the payroll costs and the payroll reports. Additionally, we do expect more changes to the program in this fourth quarter and before the end of the year, and possibly even some blanket forgiveness or other changes to the treatment for tax purposes.
I haven't seen any questions come through on the chat. So if you've got some, please send them. We've got a couple minutes that we could talk. Just want to reiterate that I do think this is one of the most important years for tax planning that we've seen in a long time. There's so many opportunities out there in regards to, quick claim for refunds or, the qualified improvement property now being allowed for bonus depreciation for 3 years that we can go back and get, that deduction. So I really think it's time to really look at what was done on those years' returns and see what we can do to take advantage of some refund opportunities. Also, gifting is something that I strongly think needs to be in every conversation with every client and with your personal tax advisors about, what does gifting look like for you? And is it time to really take a dive into that and to make some changes that'll help?
It looks like we have had a couple of questions come through. There is one, if you are a partnership using partner draws as covered payroll on the forgiveness application, is there a tax risk to including non-deductible payroll expenses in excess of the weeks? For example, 16 weeks instead of using 24 weeks to cover the exact amount of the loan.
Well, if you're using a draw, you're not going to have any tax effects of that. If you're a self-employed or an LLC and you're getting distributions or draws, there's not going to be a tax effect for you related to that expense, because there's not really an expense on your books.
And just keep in mind, any owners would be limited for an 8-week period to the $15,385 if their compensation is in excess of $100,000. And for a 24-week period, it would be $20,833, which is that 2.5 month period. We do have a question about, is it true that the PPP loan of $50,000 or less is automatically forgiven? Obviously, the forms would still need to be completed. I haven't seen any guidance as far as a blanket forgiveness, although we have thought that that may come out at some point. But right now, that 3508S form is what can be used to request forgiveness for loans $50,000 or less, but I'm not sure that those are automatically forgiven at this point in time. And Brittany, I'm not sure if you might be able to cover this. There is a question from someone that has an SBA 504 real estate loan, and the CARES Act paid 6 payments. Will this be taxable?
I'm not 100% sure about that. Let me confirm that and get back to them.
And again, any questions that we don't get a chance to answer, we will follow up with a Q&A email out to everyone in attendance today. We do have a question about, once the SBA officially forgives the loan, do you see any risk of them coming back to audit? And at this point, we don't know the answer to that. Again, it's just making sure that you have all of your documentation maintained, especially as far as any shutdowns, if there were any restrictions due to OSHA or the CDC as far as limiting operating abilities during the covered period. And during that time, making sure that you maintain all that documentation, because it's going to be a lot easier to have it on hand now and collect now than to look back and try to figure out what was going on at that time. And as far as the question, is the covered period 8 or 24 weeks? That's going to depend. The 8-week period applied to loans that were received before June 5th, but they do have the option to elect to use a covered period of 24 weeks. And again, you may request forgiveness before the end of the covered period if you've exhausted all of the funds. The biggest thing to consider there is if there were any reductions in payroll that may impact the expenses that are eligible for forgiveness during that period, because any reduction greater than 25% is going to need to be applied through the period of payroll expenses.
Okay, we just received a question that if we receive no official forgiveness from the IRS in 2020, then is the taxability a 2021 issue actually? Yes, so that is the big timing issue that we talked about a little bit in regards to the fact that your expenses are going to be incurred in 2020, but those expenses don't become non-deductible until the loan is forgiven. And so if the loan is forgiven in 2021, then that's when it becomes a taxability issue. And so that's when we're going to have to figure out, you know, how we account for that in 2021 if the expenses were already taken in 2020. I believe we've just about come to our hour time. We appreciate everyone for listening in. If you have any additional questions, our contact information is available on your screen. Please feel free to reach out. I know one of the Brittanys can hopefully get you an answer. We really appreciate your time today, and we hope this was helpful.